Let's do a quick recap of the concepts in commercial mathematics. The first chapter was GST, which is Goods and Services Tax. So the very basic things that are required to be able to solve questions are written over here. So I'm explaining them. First thing, that for any transaction, if there is any discount involved, then first we need to find the discount on the marked price. Every product will have a marked price or list price, so we need to find the discount. We need to apply the discount percent on the marked price. Usually discounts are given as percentage, 10%, 20%. So we calculate the discount, and then the discounted value or the selling price will be the marked price minus the discount. So this is one basic thing that we need to know. And in case there is no discount involved, then the selling price is same as the marked price. So our first target for any transaction, if the aim is to find the amount of GST or the bill amount, is that for that item we need to find the selling price. If there is a discount involved, we need to find the discounted price or the selling price. If there is no discount involved, the mark price itself is the selling price. Now the reason why we need to know the selling price is that any tax including GST, so GST is always applied on the selling price of the product. So GST value will be the rate of GST on the selling price. So for every item this is true. So GST is generally given as a percentage. Now in case there is any location given where the transaction is happening, in which state the transaction is happening, suppose if one situation is that the transaction is happening within the same state, which is also known as intra-state transaction, then the GST is split equally into two parts. One is SGST and one is CGST. CGST is central GST, then SGST is state GST. Central government will collect CGST and state government will collect SGST, and they are split equally. So whatever is the GST or the GST rate, if you divide by 2, that will give you the CGST and the SGST rates. Now if the transaction is happening in between two different states, which is also interstate, then the entire GST is taken as IGST or integrated GST, and initially this IGST will be collected by the central government. Now as per your syllabus, IGST is not there, so you will not have questions specifically asking about interstate transaction or IGST, but you will have questions based on CGST and SGST for intrastate transaction. Now there is a small topic on multiple transactions, but there have not been many questions asked till now. Now in case any goods or service is being sold at multiple points and we have a final customer, in that situation we need to understand how is the tax flowing, who is paying how much tax to whom. That should be understood. So I have written an example here. For example, there is some product whose marked price is 1000 rupees, and let's say the GST rate is 5%, and A sells to B, B sells to C, and then C does not sell it further. And we are assuming that A and B are registered with GST, so they are charging GST and they have to send that GST to the respective government. Let's say that person A is selling the item to person B, and since the mark price is 1000 rupees and let's say there is no discount involved, the selling price at this point will be 1000 rupees itself. And if I calculate 5% tax on 1000 rupees, that comes up to be 50 rupees. So person B has to pay in total 1000 rupees, 1000 plus 50 rupees, that is 1050 rupees to person A. So person A is collecting 1000 rupees plus 50 rupees tax. Now person B does not want to keep the product. Person B wants to sell the product but at a profit. So let's say that B tries to make a profit of 200 rupees. So when person B is selling the product to person C, then the selling price at that point will be 1000 plus 200, which is 1200 rupees. And then person C, when person C is buying the product, they have to pay 1200 plus 5% tax on that. So if I calculate 5% on 1200, it will be 60 rupees. So person C pays 60 rupees tax and person B is collecting that 60 rupees tax. So in this transaction, we saw that there were two transactions happening and GST is applied on both the transactions, and person A is collecting 50 rupees tax, person B is collecting 60 rupees tax. Now the first person, let's call person A as the manufacturer or the first person who is selling the product, they will have to send the entire tax collected to the respective government. So if person A is collecting 50 rupees tax, that 50 rupees has to be sent to the government. In case this was intra-state, then the central government will receive half of it, 25 rupees, and the state government will also receive 25 rupees. Now the person B is of interest because person B is already paying some tax while purchasing and is also receiving some tax while selling. So for person B, when they are purchasing the product, that tax on purchase is known as input tax, and that is 50 rupees here. And when person B is selling the product, they are collecting tax on that. So the tax on sale is the output tax, which is 60 rupees. So person B has already paid 50 rupees tax and is collecting 60 rupees tax. So that difference between these two taxes, which is 10 rupees, has to be paid to the government. So B has already paid 50 rupees tax to A, and now B has to pay the additional 10 rupees tax to the government. So the government in total is receiving 50 plus 10 rupees 60 as tax, which is the exact amount that the customer C had paid to the person B while buying the product. So this 60 rupees tax overall is flowing to the government. Person A and B should not hold any tax. They have to give away the tax as they are collecting it. So we say that the net GST payable by the dealer B or the person B is same as the output tax minus the input tax, and that is also same as if you apply the rate of GST or the GST percent on the profit, on the dealer's profit or the value addition, because the value of the product was initially 1000 rupees, and because of B selling it at a higher price, that's the profit or the value addition, the addition in value in the product. Now the next chapter is on banking, which focuses only on recurring deposit accounts. So the idea is that how do we calculate the interest for recurring deposit accounts? So the idea behind such accounts is that a person will have to pay the same amount every month for a period of time, and then at the end of that time period they can withdraw that money. So they are withdrawing all the money that they have deposited over these months plus some interest. So we will say that P is the monthly installment or the amount paid by the person to the bank every month. N is the time period in number of months. So if there is a time period of 1 year, the value of N will be 12 months. And R is the rate of interest per annum. I is the interest. M is called the maturity value. So after the time period is over, the person is withdrawing everything and receiving all the amount, that is called the maturity value. So maturity value will be the money deposited by the person over these few months plus the additional interest. So these two, when you add together, gives the total value or the maturity value. So the money deposited will be P rupees every month for n number of months. So the money deposited will be P multiplied by n. So the maturity value is P multiplied by n plus the interest I. and you can derive a formula and you can directly remember the formula that the interest will be equal to p into n plus 1 divided by 2 into 12 into r by 100. So there is a reason why the formula is written like this, but the idea is that when the person is depositing the monthly installment P for every month for n number of months, the interest is calculated for every month depending on how much money is available for the end of the month, and if you add up all those interests, this is the total interest. Now questions will be asked where some of these values are given and you have to find one missing value. So we just need to substitute the values in the formula and solve that as an equation. The unknown quantity will be the variable and we need to solve it as an equation. In one situation where the number of months, the n value is unknown, if you look at the formula, there is n multiplied by n plus 1. So you will get an n square term and that will give a quadratic equation. So you have to solve that as a quadratic equation and then find out what will be the number of months. Then the next topic is shares and dividends. So some of the concepts are written here. For every share for the company will have two types of values. One is called the nominal value or the face value, and that is fixed. But there is another type of value which is called the market value, and that can change over time. The market value can increase and decrease depending on many different things. Now if suppose we compare the nominal value and the market value, there can be three situations. One is that the nominal value is same as the market value, so we say that the share is at par. If the market value is greater, so nominal value is less than the market value is slightly more, then we say that the share is at premium, and the premium, the value that we are talking about for premium, is the difference between the market value and the nominal value. So if I know the nominal value and the premium, I can add them to get the market value. But if the market value is less than the nominal value or the nominal value is more than the market value, then we say the share is at discount. The market value is less, so it is at discount. And the discount value will be again the difference between nominal value and market value. Now suppose any person is trying to buy some shares of a company. So the shares of a company can be bought only at the market price or the market value. So if a person wants to buy n number of shares and we know the market value of one share, then if you multiply both of them, n multiplied by the market value of one share is the sum invested by the person or the money that the person needs to pay in order to buy n number of shares at some market value. Then the next thing is that if the company does well and depending on lot of factors, company can offer a dividend, which means that whatever profits the company has made, they can set a rate. They can say that we will offer this much percent on the nominal value of the share to our shareholders. So a shareholder can get income from investing in these shares. So the dividend, the total dividend or the annual income for a person who has n number of shares will be n multiplied by the rate of dividend that is declared by the company multiplied by the nominal value of one share. So this is nominal value, not the market value. Now we can also calculate the rate of return or the profit percent or the income percent. That means suppose dividend is a person is holding some amount of shares. So initially the person would have paid some money, invested some money to buy those shares, and then the person might receive some dividend. So to understand how much return or how much income was received compared to how much was invested or how much was paid to buy those shares, we can look at the ratio of income to investment. and if I multiply this by 100, that becomes the return percent or the rate of return or the profit percent or the income percent. And also there is a relation. Suppose we have these four quantities: rate of dividend, rate of return, market value and nominal value. You can find out that the rate of dividend multiplied by the nominal value of one share is actually equal to the rate of return multiplied by the market value of one share. So this last formula is especially useful in case we know 3 out of the 4 quantities and one quantity is missing, then it will be very helpful.